Hello everyone. I just want to do a bit of a follow-up video for Chapter 5 because it seems like a lot of folks had trouble with it, and looking back on the video, there were a few problems, so I just wanted to clarify a few things. So, the first half of this is just going to be talking a bit more about consumer and producer surplus and talking through a few examples. Then I'm going to speak briefly about the minimum wage to clarify some things I said about it, and that'll be the extent of the stuff that's directly applicable to questions that you might see on Chapter 5. But in the quiz responses, a lot of you seemed very concerned about inflation, so I'd like to talk about that just a bit. So if you're interested, go ahead and stay and listen to that. So first things first, let's talk about the meaning of consumer and producer surplus. So an individual consumer has some willingness to pay. I'm willing to pay, $10 for like a water bottle, right? And the price of that water bottle, because there's only one price in the market, might be below that. Say it's $8. So if I value the water bottle $10 and I only have to pay $8, I kind of get $2 of free value there that I didn't have to pay for. And that's what we call consumer surplus. Now, there's individual consumer surplus, which is what I just described, and then there's consumer surplus in general, or the market level consumer surplus. And conceptually, the market level consumer surplus is just adding up all the individual consumer surpluses. When we have a supply and demand diagram, the consumer surplus can be seen as areas of a triangle. So here on this graph, let's assume this market is in equilibrium with a price of 12 and a quantity of 4. Under those circumstances, the consumer surplus is A plus B, the area I've got shaded there. So in this example, to calculate that, we use the triangle formula, 1/2 base times height. And so here I've got the full calculations lined out for you there. But the important thing is finding the dimensions of the triangle and cranking through the formula. And this tells us that there's $16 of consumer surplus in this market. Flipping things for a sec and talking about producer surplus, it's a very similar concept. A seller has a willingness to accept for a water bottle. So let's say that the willingness to accept for the seller of the water bottle was $9. So if they were willing to sell it for $9, but were able to sell it for $10, then they kind of get that extra dollar of value that they weren't really, wasn't baked into their calculations. And so, once again, we kind of sum up all these individual producer surpluses, and that tells us what the producer surplus is in the market. Now, here, we again can, if the market's in equilibrium with the price of 12, we can just use the triangle formula to find producer surplus. So here that's area C, D, and E, that larger triangle. And to calculate that out, we can again use the area formula. And here we see that, it turns out in this market, producer surplus is equal to consumer surplus. Deadweight loss is a closely related concept. So let's say in this market, instead of it being in equilibrium at a price of 12, let's say that a policy is implemented, a price ceiling. So a price ceiling is goes into effect when it's below the equilibrium price in the market, and it changes the market outcome. So instead of us ending up at price of 12 and a quantity of 4, we end up at a price of 10 and a quantity of 3, because suppliers are not willing to provide as much as demanders want at the price of 10. And because of that lack of supply, some transactions that would have happened in equilibrium don't happen. And so that's represented by the deadweight loss area here, B and D. So so to find the deadweight loss, we can once again use the triangle formula. I needed to add an additional point here at P double prime equals 14, but that gives you all the dimensions you need to find the area of the triangle. And here, I don't think I've finished out the calculations there, but you can find that out pretty readily. So there was one mistake I made in lecture. that I wanted to just briefly mention. So in lecture, I had a example where I calculated dead weight loss by finding total surplus, that is consumer plus producer surplus in equilibrium, total surplus outside equilibrium, and then subtracting the two. And this ought to work geometrically, and my idea with that example was to demonstrate that the two approaches are equivalent to one another. The issue is that the particular example I picked resulted in one of the points that I give you, like for instance here, say instead of picking p equals 14 on the last slide, I picked p equals 18. That point, while I may have labeled it on the graph, doesn't geometrically fall on that straight line. And so because of that, the two approaches didn't end up giving the same answer because I just had inadvertently picked a point that didn't lie on the line. So the sum up here is, by and large, just stick to the triangle formula. It's always going to be easier, and I'm always going to give you the appropriate information to use it. But if you do end up inadvertently using the other method, I count both versions correct when I'm grading. I am being more careful about picking points that do fall on the line. It just takes another kind of error checking step on my part. But I just wanted to clear that up, why that might have been a bit confusing in lecture. So moving on to just chat about minimum wage a bit. Minimum wages are happening in labor markets, right? So the big difference there is instead of quantity, we have employment or labor. So we replace our Q with an E or an L. And instead of a price, we have a wage rate. And the thing that's kind of weird to wrap your head around in a labor market is we think of ourselves as consumers a lot of the time. But in labor markets, workers are the producers and employers are the consumers. We produce the labor and employers consume the labor, right? So who gets what is kind of flipped, but the names are the same. So let's say that a minimum wage is implemented above the equilibrium wage, so it means it will actually change the market outcome. Essentially what happens here is that the workers collectively, the producers, gain this rectangle. And but they give up their portion of the dead weight loss that they would have gotten had the market been in equilibrium. And we see in this example here, it just so happens that that rectangle is larger than the area of the triangle that they gave up. There's no reason why that will inevitably be so. A minimum wage could result in workers being made better off or workers being worse off. And it will generally, according to the theory, always reduce employment. And that's why we see the movement from L star here to L prime. It's also important to note that employers wouldn't like this, right? Because you can see that the consumer surplus, which employers get, has shrunken substantially under the minimum wage. Now, I think I've spoke about this in lecture at length, but I do want to highlight, in the real world, stepping outside of this model, which is a simplification of reality, but in the real world, we don't actually find that implementing a minimum wage creates a lot of unemployment. It generally doesn't. So our model predicts that minimum wage reduces employment, but when we actually look at it, it doesn't. And sometimes, oddly enough, it increases it. So I want to hit a few points of why that might be. And this is going to be stuff that's outside of the model, because the model is just very, very stripped down and simple representation of reality. So some reasons for that is the potential for very inelastic labor demand. So essentially, employers may not have a lot of leeway in hiring fewer workers when their wages go up. So we represent that on our graph by having like a very steep labor demand curve. So employers are kind of stuck. Now that doesn't tell the full story. Another issue here is monopsony. So monopsony, like I'm sure you've all heard of monopoly, but monopsony is when an employer has power because they're the only buyer of a particular type of labor. But there are other ways that these as time has gone on, we've more and more seen monopsony less as like a single employer and more as reasons why an employee might not have free movement between different employers. And that can happen for a lot of reasons. There's a lot of uncertainty involved in changing jobs. People have particular skills that may not be suited to other firms. And so because of that, workers are very, very limited in their ability to just leave a firm because, say, the wages go down. If the wage drops, it's like, okay, if it drops $1, I'm not just jumping ship. It's going to have to drop a lot. And that represents the transaction costs of changing jobs and moving between firms. And that's something that cannot be represented in our model as we have shown it. And finally, there may also be demand effects. So workers who are minimum wage workers are generally quite poor, and they spend most of what they earn. They don't save a lot. And this is good for the broader economy, because if they are spending money and buying more goods and services, that means more revenues for firms. So sometimes demand effects may offset increased costs of production for firms for having to hire more expensive labor by increasing sales, for instance. And this is a non-exhaustive list, but these are just some reasons why in the real world, when minimum wages go up, we don't often see employment go down. Alright, so that's the end of the spiel that kind of deals with stuff you might actually encounter in a quiz or exam. If you're interested in the inflation issue, hang out and listen to this bit. So, a lot of you were very concerned about inflation in the last quiz, and I get it. That's the kind of the bugbear of the day. And inflation is a serious issue, especially if it's persistent for a long time and it's at a quite high percentage. And we are experiencing a higher rate of inflation than we have for many, many years. But we're nowhere near any sort of hyperinflation. And so, while I don't want to completely say inflation isn't an issue, because it is if it persists for a very long time, there's some reasons maybe to be a little bit less concerned about inflation than you otherwise would be. So, inflation is when prices increase, and we measure this using price indices. Usually this is done with, you hear the Consumer Price Index, which is based on a bundle of goods that a normal household might consume, and then they pick a base year and say, okay, that's 100% of the cost of these goods in this base year, and if in the subsequent year, the price of those goods increase 2%, the CPI goes from 100 to 102% in the subsequent year. Broadly speaking, we can kind of divide inflation into demand pull or cost push. So demand pull is when consumers are buying more, and that's outstripping basically the imbalance between supply and demand is a result of consumers buying more. And then cost push is whenever firms are experiencing higher costs of production, and as a result, they're passing those costs on to consumers. So right now, we're kind of experiencing both. But I would invite one kind of skeptical note here, because oftentimes the increasing rate of inflation is laid at the feet of workers demanding higher wages. I mean, even the head of the Bank of England asked workers in the UK to not ask for wage increases, to do their part in fighting inflation, says the man that makes well over $1 million a year, right? So they often lay this at the feet of workers, but I mean, think for a moment. Firms like, particularly tech firms, but also like retailers are seeing record high profits during this time. And so how is it that they can say, all right, higher wages are the reason for inflation, but also showing record profits? So you don't get profit increases when cost of productions are going up unless you have some sort of market power that allows you to increase prices. And that's something we'll talk about more later in the course, along with things like monopsony in a bit more detail. But last thing I would say is inflation isn't always bad. So the first thing I would put forward is that inflation tends to hurt people who hold assets and help people who have debts, right? And that way it kind of redistributive, because people that hold assets, those assets are going to be worth assets in terms of debt, right? So so think about it this way: if a bank makes me a loan of $100, and then in 3 years' time, inflation has occurred and a dollar is worth 75% of what it was whenever the loan was issued, I, as the debtor, actually am paying back less than I borrowed, right? And this is why banks charge interest rates, and why interest rates are likely to be higher when inflation is higher. Another thing is that inflation interacts with what we call nominal wages, just dollar wages, how much people are actually buying. So there's a distinction between your nominal wage, which may be, say, $10 an hour, and your so-called real wage, which is your wage adjusted for changes in the price level. So here, this graph, which I got from the Roosevelt Institute, shows difference in hourly real wage for people across their occupational percentile earnings. So basically, if this is saying, all right, where do you fall in the percentile for people in your occupation? And so further left is people who are at the low end of that earnings percentile. People on the right are on the high end of that earnings percentile. And so the zero line is right there. And you can see that the vast majority of people up to the 75th percentile, on average, are seeing increases in their real wage. And, this kind of makes sense. Think about, driving around Salt Lake City and seeing the job ads for people at fast food restaurants, right? They're not paying $7.25 an hour. They're paying $12, $13, $14, $15 an hour. I think I've even seen some up around $18 an hour now. And so despite the fact that the people that work those jobs are just like everyone else, having to pay higher prices at the supermarket, their wages have gone up so much that in real terms, their wages have increased. And so once again, this shows that the inflation is kind of hitting the wealthiest among us harder than it's hitting the poorest among us in terms of reductions in real income. I know that poor folks are spending more of their income, so they're in that way they're kind of hit harder. But point being is because in many ways this is hitting rich people harder, might be why we're hearing so much more about it, and why we need to clamp down the money supply to slow inflation. So I'm sure you've seen graphs like this. I got this from the Bureau of Labor Statistics, but this is the inflation rate over time. And you can see that we had actually a massive slowdown in price increases early in the pandemic as people were buying fewer things. And then we've had this big steep increase. And this big steep increase in inflation rate is something that a lot of people are concerned about, right? But another way of looking at this graph, because this is just changes, right? This is like monthly percentage change in rate of inflation, right? Or it is the rate of inflation. Rate of inflation is the rate of change of the price level. So we can look at the price level over the long term. Here I've got from 2011 to near present. And you can see that this most recent bout of inflation does not look quite as dire whenever you look at it in terms of the price level. And in fact, many commentators are arguing that all that's happening now is a correction to long-term trends. So you can kind of see if you project this long-term trend line out, we're only slightly above it. And so the idea is that this is just a correction. And so prices would be at this level anyway, but because of the pandemic, we had that brief bout of deflation. We're just correcting back to that long-term trend, and it's happening all at once very quickly. So, the point being, inflation is a real fear, but I think that we need to kind of put things in the right context in that, it's not time to be as scared as a lot of people are. Alright, I think that's it. I hope this clarified some of the stuff on welfare analysis, and maybe you found the inflation bit interesting. But thanks, and have a good one.